Hey everyone, and welcome back to another episode of Data Driven Value, where we show you the tools and we teach you the skills to help you take your financial freedom into your own hands. So a little bit of different video today. Rather than a market update, we're going to be covering my kind of approach to technical analysis. So I wrote up this guide into the Cryptoverse community and shared it with the premium community over there. I had a lot of good responses from it and did get a request here just to make a video covering it, just to give you a little bit more in-depth analysis as well as kind of explanations regarding how I approach this. So we see here, kind of just to preface things, the goal of this guide is not to necessarily teach you the technical analysis in itself, but to highlight some of the important metrics that I focus on. We also see providing my thoughts, examples, and additional resources to reference just to make the learning process a little easier. I'm not a professional trader or financial advisor. I'm a self-taught, enthusiastic investor looking to increase my odds of financial freedom by learning the tools. So kind of previously in my first few years of investing, I was just going in blind, kind of no strategy really, just putting money into the market when it kind of came to me. I did find that over time I was kind of making little dumb mistakes, just buying into kind of overheated times in the market when I should have kind of just been patient and waited a little bit, recognizing kind of some of the market uncertainty as well as the risks. Just by utilizing kind of this analysis here, essentially what we're going to do is just get a better idea of the general direction that the markets are moving, and then we can kind of use technical analysis to really opportunistically position ourselves. So again, it sounds very simple when you break it down, but essentially we want to buy low and sell high, not the other way around. When you're going in blind into the market, you really have no idea kind of if you're buying into resistance, if you're buying into a bearish price pattern. There's lots of kind of little hints that we can see on the chart that'll tell us kind of where it might go in the near future. And again, technical analysis is not 100%. It's just probabilities, but if we can stack the probabilities in our favor, then generally in the long term, as long as we're investing in solid fundamental assets, then by positioning ourselves in these substantial dips or kind of times of market fear or weakness, then essentially we're going to be buying low, and then we're able to kind of position ourselves and then wait patiently for the inevitable upside to come. The market can remain irrational longer than you can remain solvent. So that's kind of why, again, we want to focus on fundamentals first and foremost. Make sure that the assets that we are buying, we do expect are going to have a bright future going forward. We want to make sure they're financially sound, just so they can weather any potential downside in terms of economic conditions. But then, yeah, so this isn't going to make you a day trader, or it's not going to make you a professional day trader. You are going to have to go and practice all these concepts. The more you practice them, the more kind of second nature it becomes. And we're always trying to learn more and more about technical analysis. It's kind of one of those never-ending rabbit holes. There's endless things you can learn. Essentially, what we're going to try and do, though, is look at a few concepts and a few things that I look at, and then how I use those to position myself in the markets. So the first thing we're going to kind of touch on here, a little bit of risk management. So I talk about risk management or the risk reward very often. Essentially, any kind of investment that we're taking, we have to expect more upside than potential downside. Otherwise, it doesn't really offer the risk return that we're looking for in that position. So top priority for aspiring traders, we can see breaking risk management into a couple categories here. So we've got portfolio risk. Generally, that just kind of comes down to what makes up your portfolio. So if you have a lot of high risk volatile assets, that's okay if that's within your strategy, but just recognize that depending what your own personal risk tolerance is, it's going to depend how you weight your portfolio. I'm just going to touch into this here quickly, but there are some tools into the Cryptoverse. So they have their modern portfolio theory and their weighted risk tools. These are paid indicators here, or paid tools here, but there are a couple. So you can get a free plan here with ITC, and then they have the dollar cost average simulation tool. So that really just kind of shows you the potential returns, kind of if you were to dollar cost average into assets over a long period of time. And then in these premium ones, you do get the modern portfolio theory tool and some other tools. They're not necessary, but definitely useful. I will kind of talk a little bit about portfolios here. So first thing I'm going to talk about is kind of breaking our portfolios into different sectors, let's say. So when I like to think of my investment portfolio, I've got my stocks and my indices. So this is like traditional stocks and index funds like the SPY. They're typically lower risk and longer term investments. So kind of weighting the majority of your portfolio to those lower risk long-term investments. Just because that's kind of going to help with the risk reward. The SPY does yield good returns over long periods of time, and definitely kind of dollar cost averaging into this, especially if you were buying into the SPY kind of strategically on those retracements that I previously mentioned, you can really get a lot of good returns in here. So don't let this kind of dissuade you from the potential to actually make good returns. You definitely can make a lot of money in the stock market. It's a little bit less risk than Bitcoin and crypto, especially the SPY. But yeah, so again, we're going to wait at least about, I would say 40%, kind of on the 30-40% on the low end. I kind of like to be at about 50% overall. Then we've got our Bitcoin and crypto, so very highly speculative, volatile assets. I have it here kind of, this is for just a general sense, at about 15%. I mean, I personally do have a lot more of my overall net worth in Bitcoin and crypto. I did get in at a much better cost basis. I'm really young, so I kind of have that, I have that timeline, as well as kind of understand the risks around it. So I do feel comfortable having more of my portfolio in Bitcoin. But again, when I say Bitcoin and crypto, I really emphasize Bitcoin as the only kind of relatively safe asset in crypto. And then next I would say obviously like Ethereum would be next, but kind of as we get down the altcoins, they're just less old, they've got less price history, less value in them, kind of less total value locked, less liquidity. So yeah, as you go down the crypto rabbit hole, they just kind of get riskier and riskier depending on each asset. So again, we want to prioritize kind of Bitcoin and our like relatively safer assets like Bitcoin, Ethereum. We can have our safe haven assets. So if we have like precious metals like gold, silver, maybe you have some bonds kind of earning long-term yield, very safe. And then other assets that generally outperform during risk-off environments. So this is kind of to hedge for potential downside in the market. Generally, when we see our risky assets like Bitcoin and crypto, as well as even some of the tech stocks start to sell off, you'll see a lot of that money rotating into these safe haven assets. That could be precious metals, bonds, even real estate could fall in there. If you have real estate, then definitely a safe haven asset. And then finally we've got cash. So ideally we do always kind of want to maintain a bit of a cash position because you never know when a market correction might come. So how you maintain that cash position is kind of up to you. I like to do it through a combination of income and profits from other trades. So what I'll kind of do is I'll take profits on my short-term trades a lot more conservatively than my long-term spot positions. And then I'm going to take those profits, I'm going to put it into my cash position here, and then I'm going to wait until I get those substantial market corrections, and then that's when we're going to deploy that cash position. You can also just add to it from your income. So if you have a job, then any kind of spare money putting aside, keeping it in this cash position, the more you can build it up, the better. So I like to kind of keep mine roughly between about 20 and 30%. That just ensures that I have a decent cash position. If we were to kind of see a recession or something where you would see a 20 to 30% stock market correction, you really want to be able to take advantage of those opportunities. They kind of only come around like once in a decade type thing. So yeah, just having the cash available in that event. You can keep it in a high interest savings account and earn probably like 4 to 5% in the meantime. So that's a good way just to earn a little bit of interest on that cash, as well as maintain it in the event that we do see a market correction. We can look over here now. Let's take a look. So again, breaking our portfolio kind of up into different asset classes. So this would be if I was looking at just a crypto specific portfolio, how I'd kind of weight it. So Bitcoin, typically I would aim for 50% or higher in Bitcoin for a long-term crypto portfolio, kind of due to the current Ethereum Bitcoin valuation and where we are in the market cycle. We've kind of brought that down a little bit to about 40%, but still making sure that Bitcoin is that major component of the portfolio. Here we see Ethereum, higher risk, a little bit more speculative, still good growth potential, and definitely a little bit safer than some of these altcoins here. Stuff like Ethereum, we might weight at about 15% of our portfolio. Blue chip altcoins, so well-known, established, higher market cap altcoins. Generally, they're going to be within the top 50 to 100. So anything like Solana, Chainlink, Avalanche, those kind of altcoins, like lots of ones I talk about frequently. We'll have those kind of in the blue chip altcoin section here. And then we've got speculative altcoins. So these are going to be new altcoins or low market cap or kind of like meme coins. Again, they're kind of our lowest weighting because they're the highest risk. So this is just for a general risk reward purpose. And then again, we've got cash aside used to purchase those substantial market corrections. So you see in each portfolio, we kind of weight from heaviest to lightest kind of based on risk. And then, yeah, always trying to maintain that cash position so that we can take advantage of the opportunities as they come. Going back here, so kind of looking at that, we do see our risk here. So yeah, your individual risk tolerance will vary, and that's kind of going to depend on how you structure these portfolios. It's kind of up to you. We all have different strategies. We all have different goals, so you kind of have to come up with your own. But this is a good little introduction, I think, for some people to kind of take a look and maybe mess around with a little bit. You can adjust it how you see fit. Going down, we're just going to talk a little bit about time frame here. So understanding the time frame of your investment and trade. Definitely we want to do our long-term investments on the high time frame. So looking at probably the weekly chart, maybe the monthly chart. The daily chart can be used in conjunction with the weekly chart, but really we're going to look on the high time frame. So for a long period, we're going to look on that weekly chart. That's where we want to see confirmation of our trends and our patterns to really just get a good sense of where things might go in the next months or years. So thinking of it, we can look at if we look at the 1 hour, the 4 hour, and the daily chart, we might be looking at what's going to play out over the next few days or weeks. And then when we're looking at the daily, weekly, and monthly chart, we're kind of going to be looking at what might play out over the coming months or years. So you can kind of understand the different time frames. I just refer to them as high time frame and low time frame. We do see that the lower time frames, the price action will start to it'll start to print on the low time frame, but it's going to take a while for that to actually translate to the higher time frame. But by watching that lower time frame, we can start to see the trend change before we even start to see it even show itself on that high time frame. So it just gives us a little bit more information about what's happening in the near term, if we can expect kind of a reversal coming in the next or in the very short period of time. It does allow for slightly riskier but better entries. That being said, if you wait for confirmation on the weekly time frame, it's always going to be a little bit less risk. But that, again, you're going to have a slightly higher entry. It's not the end of the world because generally the price targets that we are targeting are much higher. So a few percentage difference in your entry isn't going to make a whole world of difference in the long run. Just keeping that in mind. So we see here also trade risks. So each trade is going to come with its own individual risk. So here I use the RR ratio. The simply ratio takes the projected returns of your trade and then as well as the potential loss of where you would cut that trade. So you're looking for an RR of 3 or higher, meaning the upside outweighs the downside by at least 3 times. So we can look here, just a little example. So we saw here using our long position tool, you can see as we can drag our stop loss here and then we can drag our target up here. I'll also jump over here and just show you quickly on a new chart, but we take our long position tool. And let's say, we'll just put it here for now. Let's say we went long on this bull flag here. Then you can kind of see it pulls up this green box and it pulls up this red box. If we were to drag this, essentially we pull this to where we would put a stop loss in that trade. So maybe something like that. And then we drag our target up to where we would take profits. So up here, kind of mid 120s, I would say, is kind of a good target based off of other technical analysis we'll kind of touch on later. But just to show you, here you have your risk-reward ratio. So almost 7 risk-reward. That would be a really good trade setup. And then again, we just have our stop loss under support. But yeah, you can see here, just by utilizing this long position tool right here, it just kind of automatically takes care of that when we make our plan, and then we've got our ratio right there for us, making sure that it is 3 or higher. So going back here, yeah, kind of similar, obviously, coming down. You have that stop loss just below support here, and then you've got your target at some kind of technical resistance up there, and then you can see that risk-reward ratio. So obviously with this risk-reward ratio of 9, place stop loss where structure would change if broken. So if we came back and broke these lows here, it would actually change the structure of the market on the lower time frame and just make it riskier. So that's kind of why you place your stop loss there under support. It just makes sure you're out of that trade if there is expected continued downtrend. We do see other important risk factors to be aware of. So the drawdown trap, essentially when price drops, a lot of people are under the assumption that they just need to go up that amount to get back to break even. So if the price of your asset were to drop 50%, it doesn't actually work out. If it were to gain 50% from that drop, you would still be down overall. So if you were to lose 50% in a trade, you actually have to go up 100% from that level just to get back to break even. If you go down 95% in a trade, you would need almost 2,000%, like 1,900% return just to get back to break even. So kind of looking at that here, they do have this chart. So we see the percentage gain required to cover a loss. Sorry about that. Yeah, we see here. So just a good chart. You can see if we get to that 50% loss, you need 100% gain. If we get to that 95% loss, you need 1,900% gain. So it's kind of just something to keep in mind. We're looking for setups where we're not going to have to experience this massive downside, or you're kind of just going to want to protect yourself from really getting to these lower levels. We're not going to let trades kind of just bleed all the way down to minus 95%. In terms of spot accumulations, ideally the strategy that I'm teaching you today and what we're looking at is kind of to prevent us from buying into the highs and experiencing this kind of drawdown trap. But just important to note that as the price of the asset goes down in a dip, it needs to go up more to get back to the same price. So something to keep in mind going forward. Yeah, we just want to make sure that we're not getting caught going down, 50, 60, 70%, because we're going to need a lot of gains just to get back to where we were before. Sometimes it makes more sense just to cut that trade, take a minimal loss, move on, and look at the next opportunity. We can see here, next one I touch on is the revenge trade trap. So many investors, they'll lose a trade, they want to make that money back right away to make up for those losses. Lots of the times they'll start taking trades with emotion, without patience, and without the technical backing of that actual setup. So this is a recipe for disaster. A few poorly executed revenge trades can really take its toll on a portfolio. If things aren't going your way, take a step back, analyze what went wrong, address it, change your strategy, and then apply that to the next trade. So really just learning from our mistakes when they do come, and then all really just removing that emotion and removing that that want to just make your money back right away. This is a long-term game, so yeah, we don't want to be kind of just making emotional trades and risky trades that have no technical setup. Win rate is going to be the total win rate of your wins losses in trading. So ideally you want to strive for about a 50% win rate. And then combining that with our 3 risk-reward ratio, that 50% win rate is going to allow you to compound gains as your profits outweigh the losses 3 to 1. So even though you're only winning half of your trades, your wins are outperforming your losses by 3 to 1. So you're still making money in the long run by just ensuring that. So just keeping track of your trades. Again, if your win rate really starts to drop, just take a step back and see what went wrong with those trades. Position size, this is important as a trader. You want to risk X amount of your total capital in any individual trade. So I kind of look at about 5%. So if I have money set aside for trading, I'm looking at about a 5% risk per trade, meaning that I have 20 opportunities in those trades essentially before I've lost the capital that I put aside for those. Yeah, it's essentially just giving yourself more opportunities. You're not just going to put all your money into your first trade or your first couple trades. You might not end up on the winning side, and then if you've lost all your capital or half your capital in the first trade, then you're going to be really discouraged and probably scared to kind of continue trading. So we keep it a little small, and then yeah, we just have more opportunities for those wins. Again, this is a long-term game. We want to just compound returns over an extended period of time. We're not really looking for these moon shots or anything like that. If we get them, that's awesome. But if not, that's okay. Our strategy is, again, accumulate those strong fundamental assets when valuations are cheap. So we'll touch here quickly on stop losses. This is going to depend on your risk tolerance as well as your setup. So if I'm using short-term trades, I'm always using stop losses just to protect the downside. If I have long-term spot positions, so things I'm planning on holding for years, so like Bitcoin I plan on holding for the next 5 to 10 years, I don't use stop losses to cover my Bitcoin position or my SPY position. Those are just positions I'm going to keep adding to over time. And so yeah, you can kind of see with your long-term spot positions, stop losses not as necessary. If you're doing any short-term trading, then you definitely kind of want to look at to start to use these stop losses just to protect your downside. Yeah, again here, a lot of the time in spot positions, you can even use these once your spot positions start going up and you've made kind of double your money or more. You can use stop losses just to protect those profits. They should be placed beneath technical support to avoid the potential of being wicked out. So when we see a volatile price swing, lots of the times the price will jump down or up really fast and then recover. But unfortunately, these hit those stop losses and take traders out of their positions or take investors out of their positions. So by placing it below technical support, we just avoid a bit more chance of getting wicked out. And then yeah, we see here. So next we're going to cover support and resistance. So this is a pivotal thing to learn for technical analysis, support and resistance. These levels come in a variety of forms. Ultimately, these levels are frequently bought, sold, can act as a floor or a roof for price. These levels can be broken, so it's important to mark them and see how the price reacts from these levels. And then as a rule of thumb, the more price has interacted with a support or resistance level, the stronger it's going to be. And the higher time frames are going to be better support or resistance than the lower time frames. So coming down here, we'll take a look first of all just at the few different types of resistance. So we see, zoom in, we've got our horizontal here. So again, horizontal, you can see price came in through here, reacted all through here. We had resistance back to the prior cycle, kind of resistance through here, and then it was able to break out. We see our diagonal trend lines. So these can be upsloping or downsloping. This example here is just upsloping. So you can kind of see, again, price reacting all the way through here, coming down, acting as support on that upsloping trend line. And then we've got our Fibonacci retracement support levels. So that's taking the point from this low to this high. And then that pulls up these levels. They're Fibonacci numbers. We'll touch a little bit more on those later on. But essentially, some of these levels are going to act as good support as well. Moving on kind of down here, just a few things to note with support and resistance. So horizontal support is stronger than diagonal support. And then we see Fibonacci support. Ideal zones of interest for me with the Fibonacci retracement is the 0.5, so that'd be this top line. We've got the 618 and the 786. So this is the Fibonacci golden zone. You'll hear me refer to this quite frequently. And then we've also got our base Fibonacci level down here. The more confluence of support you have, the better chance of a bounce in that level. So lots of the times you will see that you get a horizontal support zone lining up with an upsloping trend line, as well as a Fibonacci golden zone retracement. So in that 618 to 786, that's going to be a huge confluence of support, and there's a good chance you will get a good reaction from price there. So kind of just, yeah, the more we can stack this support together, the more chance that we're going to predict the probable move from that level. The Fibonacci levels, so they're a sequence of numbers often seen throughout nature. As investing and trading involves a lot of human psychology, I do find these numbers present themselves within the charts very frequently. The most common or the most targeted one is, I consider, the golden zone here. So again, I mentioned that's that 0.618 to 786 Fibonacci. Again, these are all just based on nature, and because humans are beings of nature, I do find that they do play their role in kind of the psychology of trading. We do see here Fibonacci retracements are used to find support and resistance when looking for an entry, and we'll pull the Fibonacci retracement from the swing low to the swing high. Alternatively, when looking for resistance, you'll draw it from the swing high to the swing low. I do consider Fibonacci levels valid until we've experienced a golden zone retracement. So again, to that 618, 786. Once it is played out, we then wait for the next rally to top out and pull a new Fibonacci level again from the new swing low to swing high. Here I've got my most common fib targets. So the 0.5 to 0.618, I'm going to consider that valid golden zone for less volatile assets, or assets showing a lot of relative strength. So at certain times throughout this cycle, I'll showcase it later, but Bitcoin did only experience a 0.5 retracement, but due to the relative strength of it, I considered it valid, and then we just moved up from there. Yeah, so in traditional markets, you might be looking more at the 0.5 to the 618 as your golden zone, but really kind of focusing more on that 618. And then with highly volatile assets like crypto, that 618 to 786 is kind of my more preferred golden zone. Generally, if something's going to continue its trend, it'll bounce around the golden zone. If it breaks below the 1.0 structure, so that baseline Fibonacci, it's essentially just at risk of changing market structure and continuing that downtrend. The golden zone, again, as I mentioned, is that area between the two ratios. So yeah, we kind of touched on that. So here's a little example. I'll show you it on the charts later as well. But we can kind of see here, we've got our first rally. So we see this rally played out, and then we pulled our Fibonacci level from the low here to this high. We see that the golden zone came in right around this level, and then price came back within our golden zone. We were able to buy here, and then we wait, and we see price goes on another rally. Our new Fibonacci golden zone, we take our tool from this low to this high, and then we buy in here, and then same thing from this low to this high, and we buy the golden zone again, and then from this low to this high, we buy that golden zone again. So you can see all the way up in this uptrend, that golden zone has acted as support and really good buying opportunities. If you were to purchase each of these retracements and ride the rallies up, it would be a 2 to 3 times move. So you can see here 1, 2, 3, 4, 5 different opportunities to double or triple your money. Otherwise, another way you can play this, if you aren't taking profits up here, but you want to build a position over a long period of time, it is risky to kind of put all your money into the market on the first low, because you're not sure where the market structure is going to go from there. So you can kind of see by spreading our buys out throughout these levels, we end up with a nice adjusted risk, or a nice risk-adjusted cost basis somewhere right in the middle of all these entries, and it just ends up being a really good entry in the long term, as well as you didn't have to take that excessive risk of putting all your money into the market when things kind of didn't look as bullish as they might now. We can see here Fibonacci extensions. So it's another Fibonacci tool is used to determine profit-taking targets using the trend-based Fibonacci extension tool in TradingView. So here we draw 3 points from a low to a high to a low. Common longer-term targets for Fibonacci extensions are the 1.618 and 2.618 ratios. So these are kind of what we'll target at for profit-taking levels if you're using Fibonacci extensions. And then generally, yeah, you might split your profits between the two levels, taking half at the 1.618 and then saving half for the potential to continue higher and then maybe reach this higher ratio. On the following page here, so this is a Fibonacci extension that we saw in Bitcoin. I'll just zoom in a little bit for you. But essentially, this arrow draws how I would draw that extension. So we've got our first low here. We draw it to the high, and then we draw it to our swing low. And you can see our target for that first 1.618 is 125,000. So that's where essentially you'd be looking to take profits on Bitcoin as a major resistance level utilizing the Fibonacci extension tool. Moving on a little bit, well, and we'll touch on all this kind of a bit later on as well too. We see moving averages, so another great tool in the Trader Handbook. They basically take a running average of recent price action. They can act as support and resistance as well. We do see there's a couple types. You've got SMAs, so simple moving averages, and EMAs, exponential moving averages. More information regarding the difference can be found here. But either you just choose if you like simple moving averages or EMAs better. I kind of just like the SMAs but kind of see here, important moving averages to watch. I've got a bull market support band indicator. So that's an average of the 20-week SMA and the 21-week EMA. This is a high time frame moving average, and it's ideal for cyclical assets, especially Bitcoin. You want to see stuff above its bull market support band when in times of strength, and then obviously during times of weakness, you'll see assets kind of stuck below that bull market support band. Other moving averages I do watch, the 8-day, the 21-day, the 50-day, and the 200-day. So yeah, obviously the lower the time frame, they're going to be faster moving and signal short-term moves, while the higher time frame is slow moving and kind of signals the long-term trend. And then again, so tools you can use, the ITC Bull Market Support Band, TradingView Indicator if you do have a membership. Otherwise, you can use the Moving Average Ribbon Trading Indicator, and that just allows you to have up to 4 moving averages at once in TradingView. So you can kind of see, you can come here and customize it as you see fit, change it from SMAs to EMAs if you want, and then you can change your length here if you want as well. But you can see there, another good tool to use, just helps us gauge where we see support and resistance. Something you want to note regarding moving averages, you want the price obviously below the moving average as additional support, and you want to see that moving average angling in the direction that you want your trade to go. So if you're going long, you want that moving average to be angling up, and if you're shorting or you expect downward price action, you might see that moving average angled downwards with price stuck below it. We'll move on now to candlesticks and patterns. So candlesticks, you may be asking yourself, why do I need to learn this? Basically, each candlestick is going to give us a little bit more information on the kind of reaction at those price levels. So we can see here, you might recognize a few of these names before, but there is a candlestick cheat sheet just below I will show you. We'll see here. So we've got this, this one here. And we see the ones I'm going to really emphasize. So single candle patterns are going to be the most common. And then you'll also see a lot of bullish engulfing candles and bearish engulfing candles. So the bullish engulfing and bearish engulfing essentially just means that this subsequent candle after this one here is the reverse. So if this is a red candle, then this would be a green bullish candle, and it's going to fully encompass the entirety of the previous candle there. And then on the other side, obviously, if you have one fully engulfing the previous candle and it's red, it's going to be that bearish candle. Here you can kind of see understanding candles a little bit better. So we've got the main body of the candle here, and then these lines are the wicks. So the wicks are kind of just the extremes that the price moves to, and then the body is going to be a little bit stronger. But definitely just watching for these different either single candle patterns on the bullish and bearish side. as well as kind of the bullish engulfing and bearish engulfing. Ideally, when you see prices come down to levels of support or resistance, so if you're coming into resistance and you see bearish candles start to print right into resistance, that's another kind of signal that we're likely going to experience a bit of downwards price action. Otherwise, kind of on the flip side, if you're coming into support and you see these bullish candles start to print, could signal that we're due for a reversal and maybe a bit of upside. So just watching these candles in conjunction with our support and resistance levels. We do see here, yeah, again, that's kind of what I just talked about here. Yeah, we want to see, again, if we see candles printing with confluence of multiple support resistance, then it's just going to increase our odds that we are predicting that future move. We see price action patterns. So similar to candles, they start to form these patterns. They come in many forms. Recognizing these patterns in conjunction, again, patterns in conjunction with support and resistance and candlesticks. We now have 3 different tools we can use to kind of identify potential areas of reversal or entries. And then again, we see can help us identify macro trends. We do require at least 3 data points to consider a trend valid, and the more data points you have, the stronger the trend's going to be. I do like to see multiple higher highs and higher lows, but you can assume a trend kind of just based off of 3 points. It's just going to be a little bit more dubious than something with multiple points. So we kind of see here, just looking at a few of the trends, we see our uptrend, so higher lows and higher highs. You can see all the way through here, it's just an uptrend, higher lows, higher highs. Moving on, we see our downtrend, so that's kind of our lower highs and lower lows. So after this move here, we kind of topped out, and then we see we went into a bit of a downtrend for a little bit. So yeah, recognizing that kind of difference in trend, we see a bullish trend reversal here. So a break of the downtrend structure with an initial higher high breakout followed by a subsequent higher low basically signals that the downtrend is coming to an end and that we're likely going to go into a period of reversal. So you can kind of see all through here. In that downtrend we got here, this was actually the first higher low. You can see higher low than this one here. We were able to go up, we broke this high here, we came back, we retested, we bounced here. So this would be where you want to enter in the uptrend if you're waiting for confirmation on the high time frame, and then you're able to ride all this momentum all the way up. So you can kind of see why we wait for that confirmation. We do see bearish trend reversal, so that's kind of just the opposite of the bullish trend reversal. It's kind of marked kind of right through here. So this was a bit of not really an uptrend, but tried to form a little reversal here, didn't really work, and then ultimately just continued that downtrend structure. So that's kind of what that looks like there. We got trend pattern breakout and breakdown price action. So just touching on that, rarely does an asset break out cleanly without retesting that breakout point. And because we want to minimize risk, we're going to wait for these breakout retests, because if we haven't broken out, we're just coming into resistance. That's kind of, you kind of run the risk of getting rejected, and then you end up buying what's called a falling knife, and you're kind of buying into a downtrend. Just by waiting for this breakout move, it's just more bullish price action, and then we can kind of see, generally you look for that higher low to print, and then we get in on that higher low and then go up from there. And then again, yeah, when price breaks out, it often backtests that resistance or support zone and then continues its move upwards. So we'll look below. I'll show you a few examples. We can see reactions off these breakout back tests is pivotal. So yeah, when they break out, we want to make sure that that higher low structure is forming, and we want to make sure that our momentum indicators, so I'll touch on those in a little bit as well, but we want to make sure our indicators are kind of supporting that move that we're expecting. And then we can tell if it's a fake out move or if it might be more of a sustainable actual reversal. So then we can see here, the trend is your friend until the end. By waiting for confirmation of the trend direction, we increase the odds that the trade is successful. And during downtrends, it allows us either to avoid buying that falling knife, or it might even allow us an opportunity to exit our trade if we do expect further downside. So kind of zooming in a little bit here at the different examples. So right here on this bullish breakout and back test, you can see Bitcoin in this consolidation pattern. This is the downtrend we were just talking about up here, up a little bit further. You can kind of see it came here. We printed that higher low. We actually reversed our structure with this move here. So you see another subsequent higher low. We were able to break out of this channel. So we broke out of this downsloping resistance. We came back. We back tested it as support. We maintained that high or that uptrend structure, and then that was a valid breakout, and we continued to new highs. But then you can see on the other side, it's a different asset. We see this bearish breakdown and back test. Saw this huge rally from an altcoin. I honestly don't even remember which altcoin this is. I think it was Arrow. Huge rally. We broke back down. We lost our support zone here. And then you can kind of see when price came back up to this support zone, which is now resistance, it got rejected 2 times. It wasn't able to reverse the market structure and then ultimately bled to lower targets. So I actually was in Arrow. I forget where I bought exactly, but I was able to exit in profit. I didn't time the top perfectly, but I was able to get out of my trade in profits before experiencing all of this downside. And that was just due to this price action, just showing me kind of bearish signs. And then the momentum looked like it was going to just continue to the downside. So just cutting that trade in profit, or even before the extended downward price action, will just save you a bit of a headache in the future. So that's kind of just the bullish and bearish price actions and retests. So you can see price patterns cheat sheet. This is definitely a good thing to learn. Different patterns that you see on where they line up in the charts. You can see we've got different, so we got bullish continuation patterns here. We've got bullish reversal patterns here, and then we've got bearish continuation and bearish reversal. So just you see all the different kinds of patterns that we do have. I'm not going to go into all of them right now. I will link this document so it'll be available for all you guys to access whenever you want. But yeah, there's tons of different patterns. So kind of by identifying these patterns and identifying the trends and then looking for support, as well as kind of utilizing some of our candlestick knowledge, we can kind of determine whether something is in a bullish setup or a bearish setup, and then how we want to position ourselves for those. But moving on, we'll take a quick look at measured moves. So another useful tool with these patterns is measured moves. It is a little dubious. It plays out quite a bit, but it's not 100%. So don't expect all of the measured moves to play out all of the time. Just like all of technical analysis, it's just probabilities. But there's a few measured moves that we do see quite frequently. So we'll see a head and shoulders move, or an inverse head and shoulders on the flip side. The head and shoulders typically occurs at local tops, where the inverse typically occurs at local bottoms. And then we see here, this is triggered when the price breaks down from the neckline. And the measured move is the top of the head to the middle of the neck. And then we measure that move from where the neckline is broken, and that gives us our target. So looking at this one here, we see our left shoulder, our head, and our right shoulder. We've got our down sloping neckline, and then we see from the peak of the head to the neckline here, we have about minus 45%. And then from where we broke our neckline here, we went down 45%, and then that's where we found a bit of support, and we were able to kind of start to reverse a little bit. So you can see kind of how support landed right in on that measured move. Alternatively, on the upside, we've got an inverse head and shoulders measured move, so occurring closer to the lows or after long downtrends. So here, again, it's the same but inverted, and we want to see that upsloping neckline ideally, and then we've got our measured move. And you can see on this one, it played out, and we came right up to these highs, and that actually ended up being a local high for this asset. I believe this was Pepe, I think. Important note, head and shoulders, inverse head and shoulders are only considered invalid if the price manages to reclaim the neckline and hold it as support or resistance. So if we were to break this neckline but regain it as support or resistance, then that measured move is no longer in play. So just keep that in mind. Also to note, as I mentioned, the head and shoulders, you want a down sloping neckline, and inverse head and shoulders, you want an up sloping neckline. A flat neckline can also be considered valid for both. Some people do consider the alternatives valid as well, but ideally the higher low structure that you see in an up sloping neckline in an inverse head and shoulders is more indicative of a trend reversal, and then in the head and shoulders, that lower low in that neckline, that's kind of signaling that there's maybe some potential downward price action coming up. So that's kind of why we look for the upsloping and downsloping necklines. We've got bull flags and bear flags, so measuring the distance from the start of the flagpole to the top and then projecting this distance from the breakout point above the flag. This gives you a realistic target for the next upward move. So we can kind of see here, utilizing our bars pattern tool, essentially we saw this bull flag right here. So we took a bars pattern from this move here, this flagpole, and then we just apply it where we had our breakout, and then that's our target. So you can kind of see, although price didn't come up in the same trajectory, it still basically topped out right at the same level, so still a valid price target there. And then you can see, yeah, this huge dump afterwards, so definitely calling the top very well there with that measured move. Going down, we've got our cup and handle measured move. So here we've got a big cup and handle. Essentially, you just have this kind of shape here, and then you've got a sideways or kind of consolidation as a handle. You can see it kind of looks like a teacup, and then once it breaks out, that's where we're going to find our measured moves here. So by taking the cup height from the right peak to the cup low, and then adding that height to the breakout point, that's going to give us our measured move here. So obviously I have it broken down. Right peak is 74,000, cup low 15,600, a height of 58,400. So if we add that onto our breakout point, then that gives us a measured move of 126,400. It's also interesting to note that there is a bit of confluence of this cup and handle target in addition to a Fibonacci extension target. So interesting, we will be watching this level right around the mid 120,000 region. It could just act as decent resistance in the future there. A couple things, final notes. Remember, these measure moves, they're simply estimates. They give us an idea of where price can go. They don't play out 100%, just like all technical analysis. But it is, interesting to note that on Bitcoin, we did see that confluence of the Fibonacci extension and the cup and handle target. Going down here, we'll take a look at some of the indicators as well. So we got TradingView Indicators. A lot of people make the mistake thinking they need tons of fancy indicators to try and know which way the market's going to go. There's lots of paid indicator services that can be beneficial, but I argue that there's a ton of information available to free to all of us, a lot of indicators. So we could just get a lot more knowledge just by utilizing the free indicators available in TradingView. If you do have an Into the Cryptoverse premium account, then there are custom TradingView indicators available to you as well. You'll probably see me referencing those over the next months, years, kind of as time goes on. I'll continue to use those in conjunction with my other analysis. We do see TradingView Free allows you to have two indicators open at once, as well as the volume indicator. That doesn't seem to register as one. So generally, yeah, you're able to have two indicators and the volume indicator plus on your chart at once. So it's enough information, and then if you do want to use other indicators, you just have to remove the ones that you have actively open and then replace them with other ones. So the real benefit of premium TradingView is you're allowed to have about as many, it depends, like you can have a lot more indicators open on the chart at once. So I probably use, regularly, probably about 10 to 12 different indicators. Every day I probably use about 6 to 8. So you can see, for me to have only be able to have two indicators open at once and to be cycling through 10 or more indicators frequently, it's just going to just be a little bit of an inconvenience for me. So that's kind of why I prefer premium for TradingView. But I want to emphasize, I got by with the free TradingView account for the longest time, for the first few years of my investing. So definitely don't fade TradingView just because you only have the free option. there's still a lot we can do with it and get a lot of information from those charts. A lot of the indicators that I'm going to talk to you about are free anyways, so they will be available to you. Common chart setup I do like to use for the free users. Have the MACD, the RSI, and the volume indicators open. Those are the three I would watch the most closely. And then we can see the indicators are basically statistics used to measure current conditions as well as forecast financial or economic trends. So momentum indicators just show us whether an asset is overbought or oversold, and can kind of signal whether they're due for a bit of a reversal or kind of, trend change, that type of thing. Again, we want to use our indicators in confluence with the other things we've discussed above. So when we're coming into support, we want to see those indicators oversold, signaling a likely reversal and trend change. And then when we're coming into resistance, if we see that the indicators are overbought, then we kind of think of that as maybe an unsustainable move and might be similar to that bearish back test and continued breakdown. So just seeing how these indicators look as we come into these key levels of support and resistance can give us a better idea of the general market direction. So I'm going to kind of just touch on this quickly. There are links here to get more in depth for all these, but first, my top indicators, I'm going to say the relative strength index, so used to determine and gauge trend. It's more effective in trending markets on a higher time frame. So it's measured on a scale from 0 to 100. Over 70 is overbought or overextended, and then under 30 is oversold or undervalued territory. Obviously, the lower you go, the more undervalued the market is currently valuing that asset at. We have the stochastic RSI. So this uses RSI in combination with a stochastic oscillator. So this is more useful for short-term trading. Similar to the RSI, again, it gives us that oversold, overbought nature of the assets. But you can see here is a lot more noise and it's a lot more cyclical. So that's why it's more useful for those short-term moves. Kind of using RSI to gauge macro trends and then using the stochastic RSI to kind of cover intraday or short-term price movements. See our moving average convergence divergence, or the MACD. So see here, it's another indicator that helps us gauge momentum alongside the RSI, made up of 3 parts, 2 lines, and a histogram. So this is the histogram here, the green and red thing that flips back and forth, and then we've got our lines here. So we've got a MACD and a signal line. And you can see here when we experience these bearish crosses, you do see generally it coincides with kind of times of overextension right before downward price action. So here we had a bearish cross and the market dumped, and then here we had a bearish cross and the market dumped, and then here we had a bullish cross and the market has bottomed here and it's gone up a bit, and then we got another bullish cross here, market ripped up, we experienced a bearish cross, bit of downwards kind of sideways price action, and then our bullish cross again, continuing to these new highs. So you can kind of see they don't line up perfectly with the highs and the lows, but it does give a good indication of kind of the upcoming trend potential. So just keeping an eye on that as well. Again, it doesn't do an amazing job at calling tops and bottoms, but it kind of, again, just helps us understand if something has most likely bottomed or is likely to reverse that trend. The volume indicator, free, helps us gauge whether a move is driven by spot buying or futures manipulation. So you want to see breakout moves supported by a large increase in volume. You want to see bottom consolidation periods. They're oftentimes of low and somewhat equal volume. So you might, and then we're going to watch for major sell volume following moves up. Generally, if you see price kind of coming off highs, moving up into resistance, and then selling off in a lower high, that kind of shows you that kind of some traders are expecting more downside and they're using that opportunity to exit their position in hopefully profit before the ultimate kind of continued downtrend. And then, so that, that'll just show up on your chart. So this is the volume indicator I just talked about here in this box. And then we've got the visible range volume profile. So this is a paid TradingView indicator. It is useful to get a better idea just to see how price has been kind of traded at those levels. And they do kind of act as support and resistance as well. So something we can use in confluence with our other indicators and levels. But you can see here how the VRVP looks and how the volume looks. We see Gaussian channel, so another macro trend-based indicator used to identify trends and potential trading opportunities. So it just kind of flips from red to green. Obviously, green is a bullish uptrend and red is a downtrend. So yeah, right now we're obviously still green on Bitcoin in the Gaussian channel. So another one we can use in conjunction. Bollinger Bands. So it kind of looks at the volatility of an asset to determine whether it's oversold or overbought. Made up of 3 lines, with the middle line being the 20-day moving average, and then the outer bands kind of show price action or we see like when the bands are really narrow, then it's kind of low volatility or stable price action, and you can expect a bit of an upcoming volatile swing either to the up or downside. Whereas you see wide bands kind of showing a more volatile price environment, in which case we might be due for kind of a more consolidation pattern coming up. But you can see here, yeah, up through here, up through the bull market, the bands really kind of diverge and get wide, and then that's why it's so volatile. And then you kind of see here in the bear market and the consolidation period, those bands really squeeze together. So you can kind of look for those as consolidation periods in the long-term time frame kind of thing. We do see here again, though, we're going in that kind of that divergence where we're kind of more indicative of the bull market. Obviously, we are in a bull market right now. The next one I like to look at, and I recommend people, is another free one, is the order block detector from Lux Algo. So Lux Algo has a ton of paid indicators as well as a bunch of free ones, so it's pretty cool. I like this one. You can say just search for it on TradingView, and then it automatically pulls up the market order blocks within that time frame, and then just helps you gauge those as levels of support and resistance. So when we pull it up on the chart here, you can see obviously this was where we had resistance, and then this is where we've got buy limit orders down here on the high time frame. Moving on, we see our L3 Banker Fund Flow Trend Oscillator. So another free community indicator. This is my big money or whale buy indicator. It's also similar to the RSI, kind of gauges trend, and then flashes these gold bars when there's substantial buying or like big buys stepping in. Generally, these gold bars kind of do precede moves up. The more gold bars we have stacked together, kind of signals that big money has more conviction at those prices. So if we look at it at the chart here, you can pretty much see basically throughout both bear markets, that's where all the big money was buying. You can see through these gold bars here. They're not really buying during the uptrends, so they position themselves during the times of downward price action, and then they ride the upside. But you can see if you were to buy over here, it would be quite a long time. Like, you got to have a lot of patience in this market, because that didn't play out for the next like couple years there. And then same thing here. If you're buying here, it's quite a long time, a couple years for it to play out to where we are today. But just kind of shows you, yeah, this kind of says this is where you want to do the buying when things are low. And again, as I said, we want to buy low and sell high. And then again, there's the Into the Cryptoverse TradingView indicators I mentioned. So the bull market support band is one I frequently look at. Short-term bubble risk and ITC net liquidity is another good one to look at. If you do have a premium account, definitely check out those and get your account set up for it. But if you don't worry about it. You can totally get by just kind of using all these indicators. And then any other ones that you do like using, like, feel free to explore, learn ones that you like yourself, and learn ones that work for your strategy. My strategy is not going to be exactly the same as yours. So yeah, at the end of the day, we'll have little differences, but we're going to know more about the market than we did going in blind. That's kind of the end goal. So yeah, I said again here, tons of free and useful indicators you can use. Yeah, moving on, take a look quickly at classic and hidden divergences. So divergences happens when a momentum indicator, typically the RSI or the MACD, in conjunction with the price action, diverges between the two. So essentially, I'll show you down here a classic divergence. The prices are making lower lows, and the RSI or the MACD is making higher highs. And then on the other side, the hidden divergence is prices are making higher lows, but the oscillator is making lower lows. So we see divergences typically signal trend reversal or continuation. It's not always reflected immediately in price action. These are lagging indicators. It's important to utilize them alongside the other risk factors when looking at charts. Things can remain extended for a long period of time, but this helps us gauge when the market is in more of an overheated state. So looking here, bearish here, so the bearish divergence obviously marked in red. You can see right before our downtrends, and then you see the bullish divergence marked in green right before our uptrends. So, and then yeah, another one bearish there. So although we do see a bearish divergence here, it's actually played out to the more bullish price action. We haven't had a big breakdown yet, but still watching this, it is a potential. As I said, they're lagging indicators. It may take a while for it to play out, but there was this bearish divergence on Bitcoin recently, so something to keep in mind. And then last, we see using everything in conjunction. So now we have a grasp on a bunch of different concepts, from support and resistance. We know about price patterns, we know about candlestick patterns, and then we know about all our indicators. So we know how to gauge momentum, we know how to utilize the different tools and look for our entries and exits. So essentially, just using all of these together is what's going to support your strategy and give you better odds that that move plays out in your favor. Just a few tips. Manage your emotion, practice patience, come up with a plan and follow that plan. Take the emotion out of it. That's often what kind of wrecks us as traders or investors in the long term. Practice. So get familiar with the drawing tools and indicators in TradingView. Experiment with the different time frames as well as different valuations of currencies. So you can look at assets based on different currencies. For crypto, I like to look at stuff based on its Bitcoin and Ethereum pair as well as its US dollar pair. But yeah, just interesting. You can play around with that a little bit. The more time you spend on TradingView doing this stuff, the more second nature it becomes. I'm at a point now where I could just pull up a chart and without even drawing anything on it, pretty much decide whether or not that I'm interested in that chart. But yeah, it comes with a lot of practice. So just get on the charts and draw those levels and look for the setups. Identify those various support and resistance zones. Draw trend lines you see. Practice with the Fibonacci tools. Remember that golden zone and then look for confluence across these levels. Identify the different trends and patterns. Observe how price action reacts off those levels and those patterns. And then yeah, look for those bullish bearish candle patterns at pivotal support resistance. Trend line identify by at least 3 data points. The stronger the trend, the more data points that'll have. Yeah, again, look for confluence. Utilize your momentum indicators when price enters these reaction zones to determine whether that move is likely to be sustainable. And yeah, practice, 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 and more practice. Never stop learning. Analyze where things go right and wrong, and then make adjustments for your future trades. I can kind of show you a few examples here. We see on Celestia had this long uptrend from when it launched. Everybody was saying Celestia was going to be the next hottest thing up here, telling everyone and their mom to buy up here. Because we don't buy into charts like this, and we do recognize that often these levels come back and retrace, we just were patient and we waited, and we saw that price did come back down to our level. We see up here we pulled our Fibonacci, we came back, we did kind of go below our 786, but we were able to hold the higher macro low structure, so still looked good. And then you see this long downtrend that we broke out of, so we pulled our next Fibonacci here on the low time frame, and then we see we had an entry right here at the 786. And then you see after this rally, we pulled that Fibonacci as well, and we saw another golden zone entry here. So you can kind of see how I would gauge my play here. Like coming down, this high time frame 786 retracement, this might be where you're adding a spot position. And then we see price breaking out of the downtrend, and then to supplement our spot position, we might take another position here in that golden zone and then add to it again in that golden zone if that's within your strategy. And then our profit taking levels are obviously based on technical resistance on the Fibonacci retracement here, that golden zone from this peak to this low. Moving down here. So again, we can kind of see, yeah, so here, long sideways consolidation downwards. We came back, we tagged this high time frame Fibonacci golden zones. We came back to our 618. We actually came right in the middle of that 618 and 786 zone. So nice little bounce there. We came back, retested it, held that higher low. We took out this high here, so we actually have reversed the price structure at this point. And then we've just continued. We were able to break out here, and then we came back, and this is that bullish breakout and back test that I talked about. So this is kind of a multi-trade setup. Again, you have your high time frame kind of spot position here, as well as trying to take advantage of the swing breakout move here. So you see that back test, entry, and then continued up. And again, our target based on technical resistance. So you can kind of see, yeah, it looked good. Yeah, when lows came into here, the RSI was oversold. So yeah, that's another one. Moving on, this is an inverse head and shoulders move. We did see here, so I had that to this target. And then we also saw, so that, yeah, see here, again, high time frame golden zone retracement for the spot entry, and then we see our lower time frame inverse head and shoulders pattern, breakout, back test, and then we're off on that trade. Moving down, another Pepe one we're looking at too. So it's kind of even more. So looking at this was the first two trades that played out there. So you can see again we came back, got our golden zone retracement, rallied up. And then we see now we've taken another Fibonacci retracement from this rally here because these two have already played out. And then we've got our new golden zone, and you see we've got a downtrend breakout. So accumulate within the golden zone, the spot position accumulating in that high time frame golden zone. And then we see our low time frame or lower time frame downtrend breakout, and then our entry here. So we're able then, again, we've got another spot position supplemented by a swing position and then riding that momentum up. So you can see Bitcoin and ETH pairs. So I'll just look at this real quickly. So understanding Bitcoin and Ethereum pairs and how to use them to increase odds of market outperformance. A frequent topic into the cryptoverse is alt Bitcoin pairs or ETH Bitcoin. In TradingView, you can change the currency in your chart to be denominated to other currencies. So cryptos work for this. So yeah, just here you can see in the top corner, there's a change currency scale, and I just have US dollar, Bitcoin, and Ethereum marked. The reason I look at alt Bitcoin and alt ETH pairs is the thesis of altcoins is that at certain points they'll outperform in the cycle, both Bitcoin and Ethereum. So we want to make sure that when we're looking at these altcoins that we're also valuing them on their Bitcoin and Ethereum pairs to make sure that they look like they have bottomed or they're likely to be in an uptrend, just to ensure that we are hopefully positioning ourselves in the altcoins that will go on to outperform. Generally, if something is just bleeding on its Bitcoin pair, that means Bitcoin is technically outperforming in the long run and may be due just to continue that trend, in which case it makes more sense to be in a lower risk asset that technically looks better than a higher risk asset. I'm kind of looking a little bit at the Bitcoin pairs here. So you can see Arrow Bitcoin. Yeah, again, we kind of had this big long pump, and then we pull our Fibonacci, and we just wait, and we enter again in our golden zone here, and we see price then bounced from the golden zone and off on a new kind of trend there. So yeah, again, you can see the golden zone acted as good support across multiple time frames here, and then yeah, we can see waiting for that higher low structure, that change of trend, because right through here Bitcoin was way outperforming Arrow. So yeah, we don't want to be holding Arrow in times like this, and we want to be buying here when it's about to outperform Bitcoin and riding that trend up. AVAX Bitcoin, again, we see was able to hold this macro low here and then did have a higher low print here. We had a breakout of this long downtrend, came back, tagged that golden zone here, and then that would be our subsequent entry. So initial entry here, subsequent entry here, and then again riding that up to the upside. Solana Bitcoin, been a really good performer. Again, we just take our Fibonacci from here to here. Because it's been so strong this cycle, I am including the 0.5 Fibonacci along with this horizontal support zone. And you can kind of see how price came back in here a handful of times and acted as support. Yeah, interesting to note. We would ideally, if we see the Bitcoin valuation of Sol come back down to this level here, it would be a good mid or late cycle accumulation opportunity in my opinion. And then, so lastly, these are just a bunch of educational resources. So Investopedia, it's a great educational resource, various tools, can really help you with any definitions or more info around the indicators. I linked a lot of different Investopedia articles to the indicators that I talked about. We also see Investopedia Technical Analysis Basics, so more articles just about the various aspects of technical analysis. But do keep in mind, you don't want to overcomplicate things. So just by coming up with a strategy, we have a lot of time to learn all these things, so don't try to learn everything at once. That's kind of why I've just put together this little guide for you on things that I focus on at first. And then, yeah, feel free to do your own research and kind of learn your own different things about TA. There's tons of references, resources available to you out there. Here's a good, if you have zero or very little TradingView experience and you have trouble navigating tools, I would go to this guide here. It's really good. He does a great job of kind of breaking down TradingView there for beginners. Yeah, there's free educational resources regarding aspects of TA, so like Stock Charts, Chart School. It's a decent website to go check out, nice layout. There are books you can check out, so Technical Analysis of the Financial Markets by John J. Murphy, Technical Analysis Masterclass by Jody Bansal, two I've read that are really good. And then, yeah, we have tons of YouTube resources. There's countless resources out there for you guys. I do hope this guide's been useful for you, and I hope it helps you restructure your investment strategy. So for me personally, it just kind of changed my strategy from investing blind to actually kind of still investing based on fundamentals, but also just looking for a bit of a technical backing to increase the odds that I'm on the right side of the moves. As always, kind of time in the market does beat timing the market, but with very volatile assets, learning to time the market as well can also be very beneficial and just stop you from kind of FOMOing into some of the prices that some people will have you buying. Yeah, we don't want to buy high and ride our bags down 50-60%. That's pretty hard, especially as a new investor. I mean, as a seasoned crypto investor, you're kind of used to 40, 50, 60% dips. It's not the end of the day. And I've now kind of, built my strategy so that I can take advantage of these. But if you're a new investor that puts everything into a volatile asset and you see it go down 50% in the next month, it's going to be very discouraging. You might not even hold that position. You might just bail, take what you can get out of it. And then ultimately the market's just going to reverse and make you kind of eat your words at the end of the day. So again, as I say, the market can remain irrational longer than you can remain solvent. So really, we just focus first on fundamentals, and then the technicals just give us a better entry. It's not always going to call the top or the bottom perfectly, but it's just more information than going in blind, and I do argue it's worth doing that. I'll kind of take a little bit how I look at different charts here. So pulling up Bitcoin, just looking at, so I want to mark horizontal resistance. This is a good example here. So we see the price kind of came into here and it's just acted as support and resistance previously. So yeah, wicked here in the prior cycle, got rejected, and then we see all this price action through here. So this is a good level of support. If we did see price come back to this level here, I would be looking at buying for sure. And then generally, we're just marking the other strong levels of support. So you can see all through here, we had support. Here it acted as resistance, and then back in the prior cycle, it also acted as resistance here, and it acted as support right through here. So lots of price action in that level. Same thing here, lots of price action through here as support and resistance, and down here. That's just kind of how I look at support zones. So pulling up the weekly chart, draw some of those key levels. Then you can even zoom into the low time frame, and essentially you're going to do the same thing. So we see here, I just identified these kind of two levels. We've got this support zone here, and then we've got this resistance zone here. And then we've kind of got this middle line between. So I kind of consider this just trading in a bit of a range. So yeah, we've got our range low zone, we've got our range high, and then we've got our kind of mid zone acting as support and resistance throughout. Yeah, so watching that. We can move on. So this is how I kind of look at the diagonal trend line. So obviously you can see in Bit Digital here, riding this diagonal trend line up, acting as support. Same thing, zooming in to the lower time frame, you can also use these in conjunction. So you see with Bit Digital, we see on the low time frame, we also have this down sloping trend line. We are coming into resistance of this, and this is when we want to see kind of price action like this, where we come out, break that previous high, and then we back test this as support and continue that breakout. But yeah, watching that trend line. Looking at WGMI, so this is the Fibonacci levels that I frequently talk about, showing you throughout this whole cycle. Essentially, if you just bought the Fibonacci golden zone, you're pretty much nailing the lows almost every time, and then you're able to ride those dips up, and then taking profits as they come, or just building that position as well. So just by building at these lows, you're just taking away a lot of the risk. But I'll show you here kind of how I would draw that. So I come over here to my Fibonacci retracement tool. I come to my swing low of the current rally that we're in, to that swing high, and then that gives me the level here, and then that's where we're entering. Looking at Pepe, this is our Fibonacci extension. So this is one that did play out. We've got our Fibonacci extension tool. So if we were to grab it here, again, just in below the Fibonacci retracement, from this swing low to this swing high, back down to this swing low, and we see our 1618. So that's what I talked about as resistance. See how price came up to that point, wicked into it, rejected. That was the high, so you can see, and then into this downtrend structure that we're currently in. So we're watching that. Moving on again, sorry about that. Yeah, so essentially that's all there really is to it. Like, it's just identifying the different levels, looking at the different indicators. So I'll pull up some of my indicators as well here so you have a better idea. Like I said, I watch a lot of different indicators. Let's see here, and I'll remove my drawings just to make it a little cleaner. So you see here, I've got my MACD indicator, looks good. I've got my RSI indicator. I've got my whale buy indicator. You can see where the whales were buying here. So not a lot of whales buying over here right now. Generally, they do all their massive buying in the bear market lows, similar to what we saw last cycle. And then coming here, so yeah, we've got the volume range visible profile here. If I were to look at my bull market support band for Bitcoin, I think it'll come up here. I'll move my moving average. So this is the bull market support band I was talking about. You can see how it just rides kind of up and below this trend line. Obviously, you want to be above it for the bull market. Hiding that, we go Gaussian channel. Obviously, our order block detector on Lux Algo. So we do have another order block here now. It is a new one just since I did that guide. And then also our moving average here. So that's that moving average ribbon I was telling you about, and pulls up all these moving averages. So yeah, if you want to look at indicators, they're all in here. You can just search them if you're looking for the ones I talk about. Otherwise, there's tons of community ones you can look through. There's technicals here. Tons of different options. So you have all sorts of tools available to you. I just think that as investors, we should kind of know as much as possible. Kind of similar to most things now, with the amount of information available to people, I just think it's a little silly to be going into things blind. Personally, I really do like researching things, so technical analysis and learning it has really been fun for me. I kind of just stopped spending time researching other things that weren't as beneficial to me, and really prioritized learning the analysis, because it's going to help me achieve that financial freedom that we're all working towards. And again, it's going to help us avoid FOMOing, buying into resistance. So I just want you guys to kind of learn from my own mistakes. I mean, I made the same mistakes that everyone else has made. We've all FOMO'd into assets in resistance. Everyone in crypto has probably ridden, 40, 50, 60, 70, 80, even 90% down in certain assets. And it messes with your emotions. It's hard to stay convicted in those assets. So just by using this strategy of fundamentals first, backed by the technical entries, again, I just remove all the emotion. I let the charts do the thinking for me, and then I just position myself and I'm patient and I wait. So as easy as it sounds, yeah, we're buying low, we're selling high, we're managing our emotion, and we're being patient. So if you found value in this guide, I do appreciate if you can share it around, share it with your friends and family. Also, if you like, share, and subscribe, I'm going to bring more content to you like this. Also, yeah, this whole document, as well as other documents as I kind of write them up and release them, they'll all be made publicly available to you guys on a Google Drive. So you're welcome to just reference them whenever you want. Thank you very much for taking the time to listen to this video. I know it's been a bit of a long one, but there are a lot of concepts I wanted to cover. Anyways, thank you again, guys, and we'll see you in the next one. Bye.